We take your research stack, all that data, and boil it down into, well, actionable knowledge. And today we are really diving deep into the Thai real estate sector. We're trying to settle a big question, one we hear a lot. Which is the better bet right now? Is it land and houses, LH, or is it SPALI, SPALI?
It's a classic matchup, isn't it?
It really is. And I think it's more than just, comparing stock tickers. It feels like a showdown between two really different ways of doing business.
Yeah, absolutely. You've got LH, the sort of established giant, everyone knows them for stability, that recurring income model.
Right.
And then there's SPALI. They're the aggressive challenger, aren't they? It's all about volume, hitting those value price points and really pushing for rapid growth.
So our mission today is to cut through the noise. We'll dissect the latest financials we can get our hands on looking ahead to 2024, 2025, and give you, the listener, a kind of roadmap. Which path makes more sense for your own investment goals?
Exactly. We need to get beyond just looking at, daily price charts. We're digging into the fundamentals, things like gross profit margins, return on equity, the strategic decisions they're making around their project backlog.
On those valuation multiples, the difference is, well, pretty stark.
It really is. So we'll structure this across 4 key areas. First up, stability and returns, think dividends. Second, efficiency and quality. Third, that raw growth potential. And finally, how the market is actually pricing these two right now.
Okay, sounds good. But before we look forward, maybe let's just quickly anchor this. Historically, the Thai property sector, it had some good momentum, especially leading into 2021, didn't it?
Oh, definitely. Back then, around March 2021, LH was showing a pretty solid year-to-date return, something like plus 8.18%.
Okay.
And SPALI may be lagging just a bit, but still strong at plus 3.41%. So, both were benefiting from the sector tailwinds.
But their resilience, how they handle downturns, and crucially, their growth paths forward, that really depends on these core differences in how they operate, right?
Exactly. Which I think leads us perfectly into our first big topic. We need to understand not just what they sell, but how they make their money, because that really dictates their stability, especially when we start talking about dividends.
Okay, let's unpack that. This divergence in business models said LH is more than a home builder, SPALI is about volume. What does that really mean day to day for their revenue streams?
Well, the LH model, it's built around capital efficiency and diversification. They use something often called asset recycling. Yes, they build and sell homes, absolutely.
Sure.
But their real strategic advantage comes from creating these other recurring income streams. LH is known for developing commercial properties, shopping centers, high-end apartments for rent, hotels.
Right, the things that generate ongoing cash flow.
Precisely. And then here's the clever part. Once these assets are stable and generating income, they strategically sell them into dedicated funds, like REITs, real estate investment trusts.
Okay, I see. So how does that recycling actually guarantee income, or does it?
Well, it creates a very different kind of income. When LH sells that mature asset, say a hotel, they get a big chunk of cash up front, a profit. And importantly, that cash injection doesn't really depend on the housing market cycle that quarter.
Ah, okay, it's decoupled.
Exactly.
Right.
And crucially, LH often keeps the management contract for that hotel within the REIT, and maybe even holds on to a small ownership stake. So they turn this big capital-heavy building into a long-term, pretty reliable stream of fee income.
Management fees, maybe some dividends from the REIT itself.
That's it. And it's this recurring revenue from the management fees, from their rental properties, not just selling houses, that really underpins LH's dividend stability. It makes them more defensive, you could say, in what's usually a very cyclical industry.
Okay, so if LH is the model of stability through this recycling, SPALI is what, the opposite? Just pure volume?
Overwhelmingly, yes. SPALI's revenue relies much more directly on selling the new houses and condos they build.
So their health is tied directly to
their backlog figures. That's the value of properties they've pre-sold but haven't transferred ownership of yet. And of course, their ability to keep launching and selling new inventory, their performance is just much more sensitive to the broader economy.
things like interest rate changes, consumer confidence.
Absolutely. And a big one recently, those mortgage loan rejection rates from the banks. If the market tightens up or banks get nervous, SPALI feels that pain almost immediately in their quarterly results, much more directly than LH.
But SPALI isn't just sitting there, right? They know this is a potential weakness. They're trying to diversify too, aren't they? But taking a different path.
They are, and it's a really ambitious move. They made a significant bet on international markets, primarily Australia.
Australia. Interesting. Is this just a small side project or?
Oh, no, this is big. It's a major strategic push. We're talking about 24 different projects over there. The total value across all these Australian ventures is huge, something like 185,500 million Thai baht.
Wow. And SPALI's direct investment?
Their equity stake is around 22,300 million baht. So, a serious commitment.
And what's the hope for this Australian business? Is it just smoothing out the bumps, or is it meant to be a real growth engine?
The forecast suggests it's meant to drive serious growth. Some sources are projecting, believe it or not, 100% sales growth in Australia for 2025.
100%. That's huge.
It is. Now, there's execution risk, obviously. But if they pull it off, it gives them diversification, a hedge against the Thai baht, and potentially a whole new revenue base. It could really help mitigate some of that domestic cyclical risk we talked about. It's like they're trying to buy stability by going global and scaling up.
Okay, fascinating contrast there. Now let's bring it back to what many investors look for first, the dividend yield. Especially now with stock prices maybe a bit softer, these yields look quite tempting compared to, say, bank deposits.
They really do. And the forecasts for 2025 are definitely eye-catching. For LH, supported by that more stable fee and rental income we discussed, the forecast is for a dividend yield of around 7.0%.
7%. Pretty solid, sounds reliable given their model.
That's the perception, yes. It feels like the baseline for relative security in the sector.
But SPALI, because maybe its stock price has been hit harder, it's promising potentially more.
That's the trade-off for investors. SPALI's forecasted yield for 2025 is in a range typically cited between 7.1% and a pretty punchy 8.0%.
8%, okay.
And, some of the more, let's say, optimistic forecasts we saw even push that projection towards 9.2% for 2025.
9.2, wow. So as an investor, you're choosing between maybe 7% that feels quite safe versus potentially 8% or even more, but knowing it might be less certain.
Exactly. You have to weigh that higher potential yield against the higher potential volatility in SPALI's core earnings.
Just quickly, looking back historically, say 2020, how do they compare them?
In 2020, SPALI actually paid out more per share, 1.00 baht, split into two payments. LH paid to 0.50 baht, also in two tranches. So both clearly prioritize returning cash to shareholders.
But again, it comes back to the source of that cash, doesn't it?
It always does. LH's potential 7% feels supported by those recurring income streams. SPALI's potential 8% plus relies much more heavily on them successfully selling houses and transferring ownership quarter after quarter. If the housing market hits a rough patch, the stability of SPALI's dividend could be questioned more quickly, whereas LH might have more of a buffer.
Okay, moving on from stability to, let's call it quality and efficiency. This isn't just about how much revenue they bring in, but how much profit they squeeze out of each sale. That brings us to gross profit margin, GPM. How efficiently are they actually building these properties?
Right, and this is an area where, historically at least, SPALI tends to win the argument on paper. They've consistently shown better gross margins than LH.
Meaning they manage their direct building costs better relative to the selling price.
That's what it suggests, yes. Better cost control on land, materials, construction. If we look back at 2020 data, SPALI hit a GPM of 38.05%. That ranked them pretty high. 4th out of 12 companies surveyed then.
And LH, where do they sit?
Significantly lower. LH's GPM in 2020 was 30.61%, ranking them down at 9th place.
Wow, that's almost an 8 percentage point difference. That's huge in this business.
It really is. It strongly implies SPALI has, or at least had, a structural edge in managing those direct project costs.
So looking ahead, the forecasts for 2025, can SPALI keep that margin advantage?
Well, they're trying, but there's some interesting pressures now. The forecast suggests SPALI should maintain strong gross margins, maybe in the 37.7% to 37.8% range for 2025. Still very healthy.
But is that down from previous peaks?
Yes, it is. They hit a peak around 38.9% in 2022, and we saw it dip to about 35.6% in 2023.
And the latest number we saw for Q1 2024 GPM forecast was even lower, around 35.2%. What's causing that downward pressure on their margins?
It seems directly linked to their big strategic shift towards selling more low-rise housing.
The detached houses, the townhouses.
Exactly. Those types of properties, which now dominate their new project launches, remember, 87% of their 2024 launch value was low-rise to all. They generally just have lower gross profit margins compared to building high-rise condos.
Condos typically have higher margins.
Often, yes, especially luxury condos.
Yeah.
So SPALI seems to be making a conscious choice here. They're trading a bit of that peak GPM percentage for potentially higher sales volume, faster cash conversion, and grabbing market share in that more affordable segment.
Okay, so SPALI is better at the direct cost of building the GPM, but GPM is just one part of the story. What about net profit margin, NPM? That includes all the overheads, selling costs, admin.
Right. And this is where the picture flips, interestingly. Looking back at that same 2020 data, despite having a much lower GPM, LH actually managed a slightly higher net profit margin.
Really? What were the numbers?
LH's NPM was 21.02%, just edging out SPALI's 20.27%.
So even though SPALI was more efficient at building, LH was better overall at keeping costs down or generating other income.
That's what it suggests. It implies LH might be structurally better at managing its operating expenses, what we call SG&A, selling, general, and administrative costs.
Why would LH be better at SG&A? Is it linked back to their business model again?
Well, I think it has to be. Think about SPALI's strategy. Launching dozens of new projects, expanding into new provinces, aggressive marketing campaigns, big sales teams. That all costs a lot in SG&A.
Right. High volume means high operating costs.
Whereas LH, with those recurring income streams from rentals, hotels, fund management fees, those probably require a relatively smaller, more stable administrative overhead per baht of revenue, and likely less constant aggressive marketing spend compared to launching brand new housing estates all the time.
So LH's superior NPM might come from leaner operations, or maybe from profits from joint ventures or other non-core activities.
Exactly. It suggests better overall cost management or perhaps more significant contributions from those other income lines that SPALI doesn't really have in the same way.
Okay, that makes sense. Now, if NPM looks at overall profitability, the other key metric here is return on equity, ROE. How effectively are they using the money shareholders have invested to generate that profit? This feels critical for long-term value.
Absolutely critical. And the good news, looking at the 2025 forecasts, is that both companies are projected to perform well here, beating the expected industry average ROE.
What's the average expected to be?
Around 10% for 2025. So both LH and SPALI are seen as being better than average at generating returns for their shareholders.
Okay, and the specific projections for each?
LH is forecasted to maintain a pretty strong and stable ROE of 14% for 2025.
14%, okay.
SPALI, again reflecting its slightly more volatile nature, shows a wider range in the forecasts. Some earlier views had it around 13% or 13.11%, but the latest, maybe more conservative view puts it closer to 10.4%.
10.4% is barely above the industry average, while 13% is much closer to LH. That's quite a spread. Why the uncertainty in SPALI's ROE?
It likely comes back to that core business model again. LH is higher, seemingly more stable, 14% ROE, probably benefits from efficient capital turnover. Remember that asset recycling.
Selling assets, getting cash back quickly.
Exactly. That cash comes back faster, gets redeployed into new projects or income streams, which boosts a key component of ROE called the asset turnover ratio. SPALI, relying more on selling houses from inventory, might have capital tied up longer on its balance sheet while waiting for those sales and transfers to complete.
So the money works harder, faster at LH.
That seems to be the implication baked into these forecasts. It suggests LH is perceived as the higher quality, more reliable manager of shareholder capital, leading to that stronger, more consistent ROE projection.
Okay, now let's shift gears completely and talk about pure growth potential. If you're looking for upside, expansion. This seems to be where SPALI really tries to shine with its aggressive strategy.
Oh, absolutely. SPALI's plans are all about expansion and volume right now. Their launch plan for 2024 was huge, targeting a record high of 50,000 million Thai baht in new project value.
50 billion baht. How did that compare to the previous year?
That was a massive 69% increase year over year, a clear signal of intent to grab market share and drive future revenue.
And the plan for 2025, are they keeping that pace?
Still very strong. The plan is for 36 new projects with a total value of around 46,000 million baht. So maybe slightly down from the record 2024 peak, but still incredibly aggressive compared to historical levels.
And we talked about their focus within these launches, mostly low-rise, targeting a specific price point.
Exactly, very focused. Remember, 87% of that 2024 launch value was in low-rise houses and townhouses. And they're really aiming for that affordable segment, mostly homes in the 3 to 5 million baht range.
Which suggests they're betting on, what, first-time buyers? People moving out of the city center?
Both, probably. And crucially, they're betting on growth outside of just Bangkok. They see the next wave of home ownership happening in Thailand's secondary cities, the provincial capitals, the growing industrial areas.
And they're putting their money where their mouth is by actually launching projects there.
Yes. They're actively expanding into places like Lopburi, Suphanburi, even down south in Koh Samui. It's a clear strategy to tap into growth in these secondary markets and reduce their dependence on the super competitive Bangkok metropolitan region.
Okay, so if they're launching all this potential future supply, that should feed into their backlog, the guaranteed revenue waiting to be recognized. What does that backlog look like now?
Well, as of the first quarter of 2025, the reported backlog stood at 13,200 million Thai baht. And it was pretty evenly split, about 49% low-rise, 51% condos.
13.2 billion, and how much of that is expected to turn into actual revenue this year, in 2025?
The visibility for 2025 looks pretty good from that backlog. About 62% of it is expected to be recognized as revenue within this calendar year.
Okay, 62%, but wait. If they're launching 40 or 50 billion baht worth of new projects, doesn't a 13.2 billion backlog seem a bit low? Especially for the years after 2025.
You've put your finger on a potential key risk for the growth story here. That remaining 38% of the current backlog, that's spread out over 2026, 2027, and maybe even 2028.
So not much guaranteed income banked for those outer years.
Relatively speaking, no. It suggests their backlog coverage for those future years might be quite thin. If the market slows down unexpectedly in, say, 2026, they have less of a safety net compared to a company with a deeper, multi-year revenue pipeline already secured. SPALI is really banking on future sales from these massive new launches materializing.
Which brings us neatly to risks. Launching at this scale must come with significant challenges. You mentioned one potential issue with a specific large project.
Yes, inventory management risk. It centers around their huge condo project, Icon Sathon. It's a massive development, valued at around 12.3 billion baht. Completed back in Q2 2027.
Completed back then, so how much is still unsold?
As of Q2 2027, the reports indicated there was still 9.5 billion Thai baht worth of inventory remaining unsold in that single project.
9.5 billion, that's a huge amount of capital tied up in unsold condos. That must be a drag.
It's a major overhang. It requires ongoing marketing, upkeep, and potentially, significant price discounts down the line if they need to clear it out. That's a real risk to future profitability.
Okay, that's one specific project risk. What about more systemic risks tied to their strategy?
The big one is related to their target market, that affordable 3-5 million baht segment. The challenge there is the persistently high mortgage loan rejection rates from banks.
So they might get a customer to sign a pre-sale agreement.
But then the bank says no to the mortgage.
Exactly.
And remember, SPALI has something like 75% of its portfolio focused right in this mid to low segment, which is most vulnerable to high rejection rates.
So a pre-sale doesn't automatically mean revenue. That high rejection rate directly threatens their ability to convert that impressive launch pipeline and backlog into actual cash in the bank transfers?
Precisely. It adds a significant layer of execution risk on top of just building and marketing the properties.
Okay, so that's the SPALI growth story, aggressive, high-volume provincial expansion, but with clear inventory and conversion risks. What about LH? Their growth story sounds much less dramatic. How do we assess their potential?
LH's growth is definitely more subtle, less about headline-grabbing launch numbers. It's implied more through that efficient capital recycling process we talked about earlier.
So selling the mall or hotel, getting cash.
And then deploying that cash, maybe into smaller, targeted residential developments that fit their brand, or perhaps more importantly for their model, using it to expand their recurring income base, buying or developing another hotel, another rental property, something that adds to that stable, non-cyclical revenue stream.
So SPALI grows by trying to sell exponentially more houses each year. LH grows by optimizing its existing capital base and steadily adding more reliable fee-generating assets.
That's a great way to put it. LH is targeting growth through, let's say, quality improvements and expanding those management fees and rental incomes. SPALI is chasing raw market share and volume. LH's path is less explosive for sure, but it's arguably more diversified, more sustainable, and carries less of that heavy execution risk tied to huge unsold inventories or fluctuating mortgage approval rates.
Which brings us perfectly to valuation. How does the stock market actually price this fundamental difference? LH's perceived stability versus SPALI's aggressive but maybe riskier growth plan. We look at metrics like price to earnings, PE, and price to book value, PBV.
And the valuation numbers really tell the story here. Based on those 2025 forecasts, SPALI is trading at what looks like a massive discount. the market seems to be heavily penalizing those risks we just discussed.
Okay, give us the PE numbers. You said the gap was stark.
It's incredible. SPALI's forecasted PE for 2025 is projected to be remarkably low, somewhere between 5.5 times earnings, and the very latest view puts it possibly as low as 5.0 times.
5 times earnings. That's very low for a major developer.
Yeah.
And LH?
LH is the opposite. It's trading at a significant premium. The forecast for its 2025 PE is around 11.5 times.
11.5 versus 5? Wow. And how does that compare to the rest of the industry?
The industry average PE for 2025 is forecasted around 8.4 times. So SPALI is trading at roughly half the multiple of LH and well below the average for its peers. LH is well above average.
Okay, wait. Let's pause here because this is crucial. If SPALI is launching record projects forecasting 100% growth in Australia, why on earth is the market pricing its future earnings at only 5 times? There must be a significant bear case priced in, right?
That's exactly what a PE of 5 tells you. The market is essentially applying a huge discount because it sees significant risks or uncertainties around those future earnings. It's skeptical.
Skeptical about what specifically? How does that translate financially?
Well, the market is likely discounting SPALI's earnings for several reasons we've touched on. First, that inherent cyclicality of purely sales-driven revenue. Second, the inventory risk. The market is probably pricing in a chance that the $9.5 billion bad of unsold stock at Icon Sathon might need steep discounts or write-downs eventually, hitting future profits.
Okay.
And third, that systemic conversion risk. With 70–75% of their product relying on mortgage approvals in a tough segment, the market doubts their ability to cleanly convert all those ambitious sales targets into actual realized profit. A PE of 5 suggests investors want a very wide margin of safety before buying into that story.
While LH's 11.5 PD reflects the opposite, the market is willing to pay a premium for the perceived certainty and stability of its earnings, even if they grow more slowly.
Precisely. You pay more for predictability.
And this discount for SPALI, it gets even more extreme when we look at price to book value, PBV, right? Comparing the stock price to the actual net assets on their books.
Absolutely. This is almost more startling. SPALI is forecasted to trade at a PBV of around 0.7 times for 2025, and again, the latest views push that potentially as low as 0.5 times.
0.5 times book value. So the stock market is valuing the entire company at potentially half the value of its net assets as reported in its accounts.
That's what it means. Trading below a PBV of 1.0 implies the market thinks the stock is worth less than the theoretical liquidation value of its assets. It suggests a deep fear of value destruction, or maybe that the assets aren't earning an adequate return.
And LH, meanwhile, still commanding a premium.
Oh yes. LH's projected PBV for 2025 is around 1.6 times. The industry average PBV is about 0.8 times.
So LH is valued at 1.6 times its book value, the industry average is 0.8, and SPALI is down at 0.5 to 0.7.
Correct. The contrast couldn't be clearer. The market trusts LH's management and the quality of its assets, especially those recurring income ones, and pays a premium. SPALI looks incredibly cheap on paper, trading deep below book value, which screams potential value opportunity, but also signals buyer beware, significant risks here.
So it really crystallizes the choice. LH is the premium quality, perceived safety play. SPALI is the deeply discounted value stock, but you have to stomach the execution risk that comes with it. Okay, we've covered a lot of ground. The business models, the efficiency metrics, growth plans, and now this stark valuation difference. Let's try to synthesize this into some clear takeaways for listeners trying to decide between these two.
All right, let's summarize the showdown. On stability and margins, SPALI actually shows better raw efficiency in building, that higher GPM historically, but LH seems to win on overall profitability and operational quality, with better NPM and crucially stronger, more stable ROE projections.
And dividends.
Both offer very attractive forecasted yields for 2025, likely in that 7% to 8% range, maybe even higher for SPALI depending on the forecast you trust.
Okay, then on growth.
SPALI clearly offers the more obvious, aggressive growth story. Those record new launches, the big push into provincial markets, the Australian diversification, it points to higher potential upside if they execute well.
And finally, valuation.
No contest here. SPALI is trading at multi-year lows relative to its earnings and book value. PE around 5x, PBV maybe 0.5x. It's unequivocally cheap, but that cheapness reflects those significant execution and cyclical risks we discussed. LH trades at a deserved premium PE 11.5x, PBV 1.6x, pricing in its stability and quality.
Okay, so putting it all together, for an investor whose main goal is steady income, reliable dividends, which way should they lean?
For the dividend investor really focused on stability and security of that income stream, LH looks like the better choice. Yes, you pay that premium valuation, the 11.5x PE.
But you're buying predictability.
Exactly. It's backed by that stronger, more consistent ROE forecast of 14% and that business model with recurring revenue that should hold up better in downturns. The 7.0% forecast dividend yield feels, well, more reliable.
Okay. But what about the income investor who maybe has a slightly high risk tolerance and is tempted by SPALI's potentially higher yield?
SPALI makes a compelling, aggressive case for that type of income investor. It does offer that slightly higher potential yield, maybe hitting 8% or more, and importantly, they've recently backed up their commitment to shareholder returns with a share buyback program.
Ah, yes, the buyback. Tell us about that.
Announced mid-2025, they plan to buy back up to 6.14% of their own shares, spending up to 2 billion Thai baht. That's a strong signal from management that they believe their stock is undervalued.
And buybacks tend to support the share price and earnings per share.
Correct, which in turn helps support the sustainability of future dividend payments. So that buyback program makes SPALI's higher potential yield feel a little less risky than it might otherwise. It's management putting skin in the game.
Okay, clear distinction for income seekers. Now, what about the investor focused purely on capital appreciation, on growth? The growth investor, where does the analysis point them?
For the pure growth seeker, the choice seems clearly weighted towards SPALI. Its aggressive launch pipeline, that expansion into new markets, the Australian angle. It all offers much more leverage if the market turns positive or if they execute successfully.
And the valuation helps that case.
Massively. Being so cheap, PE of 5, PBV of 0.5, means even partial success in converting that huge 46 billion baht launch plan for 2025 could lead to a significant re-rating of the stock. Remember, some older analyst targets pointed to nearly 30% upside potential.
But the caveat is?
The caveat is huge. The growth investor must understand and be comfortable with the higher execution risk. Will they sell Icon Sathon? Can they navigate the high loan rejection rates? Will the provincial expansion pay off? There's much higher profit volatility baked into the SPALI growth story.
So it really boils down to LH being the quality, stable dividend choice, and SPALI being the higher risk, higher potential reward growth, and deep value play.
That's the core trade-off. It depends entirely on your personal risk tolerance and your view on whether SPALI can overcome those market headwinds and execute on its very ambitious plans.
Okay. Now, before we wrap up, there's one final, potentially powerful external factor that listeners should keep a close eye on, especially if they're leaning towards SPALI's growth potential. It concerns potential government stimulus measures.
That's right. There's talk, ongoing discussion about the Thai government potentially introducing measures to boost the property market, specifically reducing the property transfer fees and mortgage registration fees down to a nominal 0.01%.
0.01%. That's practically nothing. And which segment of the market would this apply to?
The proposal focuses specifically on homes priced under 7 million Thai baht.
Under 7 million. Wait a minute. That's right in SPALI's sweet spot, isn't it?
Exactly. This measure, if enacted, acts like a direct catalyst, but it disproportionately benefits SPALI's compared to LH. Reducing those fees directly tackles SPALI's biggest challenge right now, that conversion risk due to affordability and loan rejections. It makes buying cheaper for precisely their target customers.
Given you said 70–75% of SPALI's portfolio is in that sub-7 million baht segment, this could be huge for them.
It could be a game changer. A stimulus targeted right there could unlock demand, ease the pressure from high loan rejection rates, and potentially help SPALI convert its pipeline much faster than the market currently expects. It could be the trigger that makes that low 5x PE valuation look suddenly too pessimistic. So definitely watch for news on that specific government measure. It really is the potential wild card that could narrow that valuation gap between the two stocks quite quickly.
A fascinating potential catalyst to track. All right, that brings us to the end of this deep dive. Don't forget to like, share, and subscribe, and come back for more exciting analysis like this. Thank you.